There's another episode on the channel, and there's the fifth episode we're doing on the stock market crash course series. And in this episode, we'll be looking at the risks associated with investing in security equity. Yes, so if you've been following right from the first episode, we have discussed what stocks are. We have looked at the securities market. We have also considered the players in the security market. We've looked at in the stock market. Sorry, we've also looked at share pricing. Yes, how the price of shares are determined. We've considered a primary and then the secondary market. If you are yet to watch any of those, the link is up there. Do go to the description section and then get a link to the previous video. Yes, and we'll talk about risks in investment and stock investment. Just like any other business, investing in stock comes with risks and goes with the popular axiom: the higher the risks and the higher the reward, the higher the risk. So depending if you are looking in for a bigger reward or returns on your investment, then you should be ready to foot a huge risk. Yes, but one key thing here you should bear in mind when you're talking about risks is bigger companies have smaller risks. Yes, bigger companies do not really have too much risk investing in them as compared to smaller and newer companies. Yes, because they are trying to pick up from the operation and then be able to establish that level of goodwill that put them on the level of financial strength that will be able to withstand most economic shock. Yeah, so bigger multinationals have lower risks as compared to smaller companies. So you must make sure you do a lot of engagement and risk assessment before you invest. In this video, we'll consider 4 risks. We'll look at the issuer risk, price and market risk. We'll also look at liquidity risks, and then finally foreign exchange or currency movement risks. So let's start by taking issuer risks. Issuer risks is a risk associated with a default, like a failure of a company or the issuer. So you set out to buy shares in a company, and after buying the share, and the company fails in business, so it has to liquidate or wind up its operation. In that situation, as a stock holder, you are at the bottom of being paid during liquidation, and that will even be when there is still a residue after meeting other priority obligations. Yeah, so when a company fails, then it means that you are likely going to lose your investment. So that is the issuer risk, when the issuer fails to stay in business and to be able to pay dividend and also get your stock value increases at the market value, so as you be able to make capital gain. Aside the fact that sometimes the company will still be operating without liquidating, but then the prices of the stock will continue to fall. Yes, in such a way that it won't even be attractive to keep. Yeah, so assuming you go in and then you buy the shares for $1, and after several years you could only be worth $0.2 dollars. It means that you've made as a loss of over 80%. So that is what issuer risks is the second thing. The second type of risks we will look at is the market or price risks. Yes, the market risks has to do with a general fall in the equity prices on the market. So sometimes companies may be doing well, but then the market in itself is hit by some kind of conditions that will not be able to insulate individual companies. So they will have the shares of those companies falling. For example, we can talk about the stock market crash in the early 2000s, the 2008 financial crisis, and even more recently the 2018 fall in the stock market value. So there are instances, for instance, analysts still are not too sure about the conditions post-COVID, yes, whether the market will still be robust as it used to be after the slow in economic activities were COVID. And let me give a classical example. Yeah, in the year 2000, when the stock market went on a recession, most investments, even though most companies were doing so well, but the general market effect is that stock value reduced by 20%, with Dow Jones Industrial Index, yes, recording a 22% fall in their stock. When we talk about index are a way of measuring the stock prices and whether there is a rise or a fall. Yes, Dow Jones is an American index, and it keeps 30 major American company. Yes, it monitors 30 major American companies. So they recorded close to that is 22.3% fall in their stock value. So it may not necessarily be the company may be doing well, but then the general economic condition at the market level would not be so conducive that you would have to watch your stock value fall with time. Yes, and there are also times that what we call the bull period. And the third type of risk we'll be looking at is the liquidity risk. Yes, I remember you invest to be able to reap during the good time of your investment. So there are times that you will not be able to realize your sales at a price you want. Yes. So for example, when the company shares is not performing so well, and the demand for the shares of a company is on the low. Remember in the previous video when we discussed share prices, we talked about the fact that share prices is influenced by the law of demand and supply. So when the demand for shares in your company is not matching up what you have to supply, then there is going to be a price war, which would eventually make investors to settle for a lower price. Yes, and sometimes it will not even sell at all because the company is not even performing. You've lost the value on your stock. That is the nominal value at which you bought the stock has is not matching the current market value, and there is no economic sense in keeping your shares. You want to dispose it off, but you are not getting the buyer. So when it happens like that, you are faced with liquidity risks. You cannot translate your asset of stock into asset of cash. Yes, so it becomes a problem for you. And then finally, let's look at the foreign exchange or currency movement risks. It does happen mostly when you buy stock in an overseas company which has a different currency from your home currency. What happened is that yes, the market value of your share would may rise, all right, but then when the economic the currency of the country in which you invest your money in keep falling against the major international currency, what will happen is that when you are translating your gains from investment, it will not match the reality of what you should expect. So you would, even though the stock is performing all right, when you should take up your when you should realize your stock and you are translating the money back into your currency, you realize that the value wouldn't be as you would expect. So currency movement do affect the value of stock as well. So those are the four major risks associated with stock we're looking at. Then we should be ending this episode here. In the next episode, we will discuss how to invest, the process you go through. I think at this point, we've been able to understand the stock market, how the stock market works, and the players in the stock market, how prices of stocks are determined. We know the primary market, we know the secondary market, we know the risks associated with holding a stock investment. Now, the bigger question: how do you invest in stock? How much do you need to invest in stock? And people do assume that you will need some huge kind of money to be able to invest in stock. Let's demystify that in the next episode. Yeah, if you're yet to subscribe to the channel, please do subscribe to the channel, yeah, so that you get update on new videos. Thank you very much.